iPhone 13. Based on everything we've seen, I think you'll start to see production around that starts to ramp. In terms of the base model, I mean, that's been underwhelming. I mean, that's really the 6 million units, and that's obviously going to be a jolt to the street. But I still believe overall, when you put it all together, the overall demand story with iPhone Pro, that's the key, is better than the street's expecting.
Dan, based on how we're readjusting today and going into earnings in the next month or so, are you expecting then potentially weakness on revenue, but some upside on earnings given a better average selling price?
Yeah, I think the ASPs are so strong on Pro. I mean, the mix shift we think is 85, 90%. So I think that will be enough that we still believe, take out FX a beat in terms of the quarter. In terms of going forward, look, 90 million units, that was the line in the sand. I think the worry that they were actually going to cut 3, 4, 5 million off the 90 million units. And I think as this continues, specifically Pro, if it goes into holiday season, I believe they will start to increase production again, specifically on the Pro.
Dan, when was the last time this company had a real cyclical test for this iPhone? And I don't think the pandemic counts given the fiscal transfers. When's the last real cyclical test this company's had for the iPhone business that we can look back on and see how it performed?
Yeah, you'd have to go to 2016, 2017 in terms of, and there were specific product issues that they were dealing with. But if you go back since the 2007 launch of iPhone, right, just given the ultimate install base now, it's about 1 billion iPhones, they've been able to withstand economic pressures because of that install base, because of the upgrade cycle. And this clearly, for Cook and Cupertino, it's a huge test to see if they can navigate the storm with basically unprecedented things that we haven't seen in some cases since 2009.
Dan, final question. We talked about this last time we spoke. I think it was my final question then. How would you know if you're wrong?
Yeah, the main way we know we're wrong is if we start to see wait times significantly come down for the Pro. We see specifically in China, any sort of weakness going into call it December. If that happens, then the story changes. But for right now, we're not folding on our bullish thesis. It continues to be on Pro, but clearly Apple underestimated on the base model. That's been very disappointing.
Dan Ives of Wedbush. Dan, thank you. The stock is down a little bit this morning. The S&P 500, the gains since the onset of the pandemic, trailing inflation in the United States. Let's bring in Taylor Riggs for more. Hey, Taylor.
And John, you're looking at it sort of an unchanged S&P 500. So if you get losses today on the S&P 500 and close at that, you're looking at 7 straight days of losses. That is the longest losing streak on the S&P 500 since February of 2020. And the losses haven't been insignificant. In some days, you're really looking at maybe 0.5 or even 1% decline. So getting that a little bit under pressure today. The interesting story is also within the bond market. John, overnight, of course, you had a 10-year that touched 4%. Of course, now we migrate back downwards to about a 3.83. But the point here has been a 10-year yield that actually is relatively attractive. I'm going from TNet to Terra. There is a reasonable alternative relative to that dividend yield, right? When you think about the opportunity that closing in on 4% on a 10-year yield actually represents in this market. Finally, take a look at sort of the next board. When we think about full capitulation, Gina Martin Adams is saying that instead of maybe half of the indicators looking at full capitulation of what we had in June, a lot of maybe now 75% of those indicators, including the VIX, are pointing us more towards a bottom. When you think about an accumulation of finding a bottom in this market, a VIX that hovers above 30, around 33, is one of those signals that she's looking at.
Taylor, great work. Thank you. Just unreal. Just to see the S&P 500, not today, but yesterday at the close, back to lows we haven't seen since November 2020, and getting close to wiping out all of the post-vaccine gains from the pandemic. Unreal. The S&P down another 1/10%, the Nasdaq down by 0.4%. John Hancock's Matt Miskin expecting a recession to drive the Fed's pivot, writes the following: the central banks are the ones breaking things across markets and economies. We see a recession starting in a couple of months and lasting into 23. The Fed funds rate could even go back to 0% lower bound because the Fed will need to do all the heavy lifting to get us out of the next recession. Matt Miskin joins us right now. Matt, let's go there. Back to zero. Really, how quickly?
I mean, what's going on in the bank with the Bank of England and with what's going on with the UK right now is a great example that fiscal policy cannot be the lever to get a counter-cyclical measure to get economies out of recessions. If you're doing all this fiscal spending right now, the cost of capital has gone up so much that the interest burden for these countries are going to be so significant that the Federal Reserve or the central bank is going to have to be the counter-cyclical measure. And I think if we're not going to get all the fiscal stimulus we've gotten out of these last recessions, then the Fed's got to get us out. You break it, you own it. And the Fed is breaking things right now. Well, they got to own it. And that means they're going to have to be cutting aggressively once we get into this recession.
Where would inflation be in that recession, Matt, and why are you convinced they're still going to cut?
So inflation, in our view, is coming down because you look at, copper prices, lumber prices, oil prices. Then you look at the housing market. Housing market, it takes forever, it feels like, for that data to show up in the consumer price index because of the way that it's calculated. But nonetheless, month over month, housing prices are likely coming down significantly. And look, it's a risk, inflation right now, I get it. But at the same time, the Fed has already injected a lot of tightening into the system. Monetary policy works with a lag. We're not even going to feel all this until the beginning of next year, into next year. That should really dampen demand, which unfortunately will dampen, or fortunately, will dampen inflation, but it's tough to just decrease demand like this.
So Matt, let's just say you're right. And I'm sure there's some people shouting at the screen. There always are, saying you're wrong. But let's say you're right. How tradable is this call? How tradable is it?
John, I mean, Taylor had, you get the CFA charter holder here, and you're now coming up with new acronyms about, Tina's gone, and now we got Tara. I mean, this is what this market's all about, right? But, there is alternatives. There is. And if we can get 5-6% yields almost on investment grade bonds, and then potentially see price appreciation going into next year. And look, it's tough right now. I get it. But we're seeing the tipping point where central banks are tapping out, saying, look, we can't have yields go up this fast. And when that starts to unravel, when that starts to turn, and we think the Fed is going to have to follow suit eventually, because if the dollar goes up like this forever, or for an extended period of time, it's going to make it very hard for us to be competitive. And, at the end of the day, that's going to result in the Fed cutting eventually next year. We think that's going to result in price gains and income, which is going to be really competitive return from bonds into next year.
Matt Miskin, just finally, you understand better than I that there's a big difference between a pause, a pivot, and cutting all the way back down to the zero lower bound. Why is the call that aggressive, Matt?
Well, it's a sequence, right? So right now, the Fed is saying that they're not going to next year they're not cutting, right? I mean, Kashkari came out saying that yesterday, and it's just like the timing of these things. Last year, we've talked about this before, John. Last year, they were saying they were going to barely raise rates, that inflation wasn't a problem. Now they're saying they're not going to be cutting rates. You follow the sequence. Next year, they're going to be cutting. And, at the end of the day, right now, we're saying short-term duration, intermediate duration, and then into next year when they start cutting longer duration. And that is actionable, and you get paid to wait. We get paid, again, on investment-grade bonds now, it's about 5%. We think that's going to be very compelling income while you wait for that price return coming out of the bond market into next year.
In 6 months, can I replay this clip to you? Are you happy me doing that? In 6 months from today. This is the timestamp. All right. Matt Miskin.
All right.
Thank you, sir. Appreciate it. Coming up,
Thank you.
A busy week of Fed Speak continues with Chair Powell on deck.
We have to balance that off with our dual mandate with full employment and trying to navigate that to bring inflation down while we do so as gently as possible is a struggle.
We'll get the views of Mohamed Al-Arian very shortly from New York with your equity market just about holding on. And your bond market yields lower by 12 basis points on a 10-year after seeing 4%. Already this morning, we're back down to 383. Just wild stuff from New York. This is Bloomberg.
balance that off with our dual mandate with full employment and trying to navigate that to bring inflation down while we do so as gently as possible, not to tip unnecessarily the economy into a downturn that actually influences the full employment part of our mandate is a struggle.
That was Mary Daly of the San Francisco Federal Reserve. The Federal Reserve contributing to problems worldwide. The Bank of Japan has to respond. The Bank of England responding to problems elsewhere as well. Gilt, a 30-year UK government bond, is down 100 basis points in today's session. On the 30-year, the yield is now 3.91. That is a phenomenal move. Mohamed El-Erian in the Financial Times a little bit earlier this morning writing the following: what is at stake here goes well beyond a disorderly tightening of financial conditions and a significantly higher risk of market accidents. Real damage is being done. Mohamed of Queen's College, Cambridge, I'm pleased to say, joins us right now. Mohamed, we're lucky to catch up with you. Can we start there? What damage is being done?
It's a whole series of damage, John, and thank you for having me. Look, there is damage being done to the average household and the average business as they deal with a negative income effect, a negative wealth effect, closure of lending markets, and inflation. Let's not forget that they're dealing with a cost of living crisis. Then there's a broader issue, which is a loss of credibility in policymaking, which means that policymakers will have to go beyond where they would normally would have had to go, as the Fed is doing in the US. And then finally, there is the longer-term standing of a G7 economy that is behaving like a developing country, including getting a reprimand from the IMF. I know you don't like that reprimand, but the fact that it happened is indicative.
Yeah, I didn't like the IMF reprimand because I think there's a bigger reprimand to be had down in Washington, D.C. that they seemingly want to avoid, Mohamed, but we can save that conversation for another day. We're both on the same page, though, when it comes to intervention. Mohamed, intervention is often unsustainable and it doesn't address the underlying issues. Within your piece today and within much of your work through the last week, you've made the point that we still have some underlying policy issues to address. Can you walk us through one by one what you think needs to happen here imminently in the next few days, the next few weeks?
Yeah, and let's take the example of the UK because I think it's very illustrative. So, John, we knew that the exit from the paradigm of easy money was going to be hard. And we thought that the major challenge was going to be the balance between inflation and recession risk, as you heard in the tape. The question now is financial stability. That it turns out that there's also significant financial stability risk, and all it takes is some action, some unforeseen action. In the case of the UK, it was the fiscal action to trigger this financial stability concern. So suddenly, the Bank of England finds itself in the ECB situation, where it has to figure out how to use monetary policy to contain inflation, and then some other measure to contain financial risk. And then these two things are in conflict. So we've discovered that this is an even more complicated exit, and it doesn't help that central banks are late. So I just think we have to buckle up our seatbelt even tighter. And we have to recognize that policymakers are no longer repressors of volatility, but they contribute to volatility. And that this journey is going to be incredibly bumpy. And hopefully the new destination is a better one because it's less distorted, but it's a very bumpy journey.
Mohamed, before we even find that equilibrium without the distortions and without the central bank intervention, many people will say, given what we've done over the last 10 years, this proves it's unachievable. We've got central banks back in the game. We can't get away from this. What would you say back?
I would say this is different. This is not QE2 or QE3. This is QE1. This is an intervention that's aimed at financial stability. It is not an intervention aimed at promoting economic outcome. They can no longer do that. Inflation does not allow them to do a QE2 or QE3. That's why they put the word temporary. Now, I said to someone, how do you feel if I tell you that this is, I'm going to come in and help you and there'll be no limits, but it's temporary? And they said, I wouldn't feel very well. And that's the dilemma they're in, that they cannot have these open-ended QEs anymore. So this is different, John, and I think that the optimism of the U.S. markets that this implies a significantly less hawkish Fed is interesting, because if it means a less hawkish Fed, it would mean because we have a financial stability problem, and that's not something we want. But that's how the markets immediately translated the intervention by the Bank of England.
Mohammed, I hear the same thing from you that I've been thinking now for the last couple of days. When I hear the Fed pivot, the Fed pause, if these central banks are going to have to pause or pivot, it's going to be for some pretty bad reasons, Mohammed. And that's not necessarily going to be a constructive thing. That's not going to be a reason to buy this equity market. Is that what you're trying to convey?
Yes, John. They're going to pivot for one of two reasons, if they pivot. One is because recession risk has become unacceptably high. Two is because we are very close to a financial accident. Neither of these things are good for risk assets. So again, if you are voting and expecting a pivot, you've got to be clear why it is they're going to pivot. They are not going to pivot because the indicators they're looking at are coming down really quickly, inflation, etc. That's going to take time. So they will pivot either for a bad economic reason or for a bad financial stability reason.
Forgive me for putting you in an uncomfortable position before I even do so, Mohammed. Just a question on the Bank of England. Next scheduled meeting is November 3rd. Two-part question, really short because I've only got 30 seconds, but I want to squeeze it in. Can they A, wait that long? And B, if they can't, how big do you think this hike needs to be?
So I was on record saying they should have done a 100 basis point emergency hike on Monday. They need to do it. They're not going to be able to wait till November 3rd. It is a very long time. And you're talking about minimum 100 basis points, and 150 basis points is not off the table.
Hey, Mohammed, looking forward to catching up. I think we're going to do that again later this week. There's going to be a lot to talk about. This market has been absolutely wild. Mohammed Al-Arian there of Queen's College, Cambridge. Good friend of ours, good friend of mine, good friend of this programme. Coming up, the Trading Diary is up next. What a messy morning. I've got absolutely no idea where this market closes this afternoon, and no idea at all. We're positive for now by 0.25% on the S&P 500. That's the price action trying to snap the losing streak of the last 6 days. Here's the Trading Diary. President Biden at the top of the hour, followed by Chair Powell kicking off a host of Fed speak throughout the day. Bullard, Barkin, Evans all on deck. Then it's Brainerd, Bullard, Mester and Daly on Thursday. Plus, we get US GDP and initial jobless claims. And on Friday, rounding out the week with personal income and Spending and the University of Michigan Consumer Sentiment Survey. Guy and Alex will pick things up in just a moment. From me, thank you for choosing Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Wednesday, September 28th. Here are the top market stories that we are following for you at this hour. It's the BOE's whatever it takes. The Bank of England pledges unlimited bond buying to save the gilt market from crash and prop up pension funds. Yields on the long end soar 100 basis points. The pound, though, goes nowhere. And no Plaza Accord. Brian Deese, National Economic Council Director, throws cold water on the idea of a coordinated attempt to crimp the dollar's rally. The currency hits another record, causing havoc in the market. And Florida braces for Ian's impact. Hurricane Ian, mirroring a Category 5 strength, on track to hit Florida, potentially causing as much as $45 billion in damages. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guys, it's really hard to know where to start today. 100 basis point move, that's not supposed to happen on the long end of any kind of bond.
Yeah, this is meant to be a risk-free asset. It's not behaving like a risk-free asset. I don't know, things are moving pretty quickly. Over the last 24 hours, you've had all kinds of events which, in isolation, could upend markets. You've got potential sabotage on a major gas pipeline. You've got what is happening in the UK gilt market. You've got the currency moves and the associated moves all the way around that. There's just, the stories go on and on. I thought the story would be Apple this morning when I woke up. That was the first story I read this morning.
That feels super old now.
So yeah, Precisely. There's a lot going on right now, and all of it, I think you can bring it all back together, but you've definitely got to spend a bit of time trying to join the dots at the moment, but I think it's worth doing.
Yeah, just to point out also, Guy, EU is proposing a new package of Russian sanctions. You have EU Commissioner, President Ursula von der Leyen is commenting right now. We're going to bring you those headlines as they continue to cross. This comes, of course, as leaks on 3 different pipelines, and also questions over Naftogaz and Gazprom, basically essentially looking at zero gas now going during the winter from Russia to Europe. And we also wind up having more economic data here in the U.S., just kind of reinforces the trend of where we're going.
Absolutely. Pending home sales, let's deal with the details of what we've got here. You've got a negative number, -2. That's down from -1. 1% I'm talking about here. Slightly worse than anticipated, but not significantly worse. We're going to talk to Zillow a little bit later on to get a take on what is happening in the U.S. housing market. But it is a consistent theme, I think. These are assets that have been buoyed significantly over the last year or so. We are now seeing significantly higher rates, Alex. All of that is coming together to send house prices lower. But what normally happens is you get a period of indigestion. Basically, you get a period where the market doesn't move very much. Then you see kind of the price resetting. And I think we may be just entering that period where basically everything kind of drifts sideways. Nobody's really willing to admit that they're prepared to accept the new prices. We're definitely not there yet.
No, we're not there yet. More headlines here, Guy. Sanctions from EU to Russia will hit individuals as well as trade. Von der Leyen saying they won't accept any Russia annexation in Ukraine, and the goal is to deprive Russia of about 7 billion euros of extra revenue. So like I said, we're going to keep our headlines on that as well. And that's just the geopolitics of the whole thing. And then we have sort of the market reaction at the same time.
Absolutely. We'll get Maria on a little bit later on, Maria Tadeo, to work our way through that package that had just been announced out of Brussels. So the big question, Alex, now is the dollar now at the point where it's starting to significantly break things? And I think maybe the evidence out of the UK does suggest that we may be getting to that point. So what we're trying to figure out at the moment is, are we getting to the point where we need to see coordinated action? There's been a lot of talk over the last 24 hours about a Plaza Accord. White House National Economic Council Director Brian Deese talking to David Rubenstein, saying that he doesn't expect that we're going to see a repeat of that 1985 style of agreement amongst major economies, which was basically designed to counter dollar strength.
Do you see any possibility of a global accord to kind of adjust currency values the way there was with the Plaza Accord, or is that just not something you're focused on?
I don't anticipate that's where we're headed.
You're never going to say it before we get there, are you? Never going to say that that's the direction of travel, because then we're already there almost. So the question of the day is a fairly straightforward one today from Alex and me. Plaza Accord 2.0. Is that where we're going? Macro strategist Vincent Signorella was there trading the last one. Vincent Signorella, probably a good guy to talk to today, as is Bloomberg's Eddie van der Volt. Vince, let me start with you. If we're not there yet, are we getting close to the point where the dollar strength does require some sort of coordinated action?
I think, regardless of what Mr. Deese says, yes, we're getting there. I think it's going to take a rush on sterling, perhaps towards parity. I honestly would not be surprised if that happened. The UK government is definitely setting the currency up for a bad run, or not that it hasn't had one already, but I mean a crisis kind of run where you sort of get that almost 1992 moment where we see a major sell-off in the pound and we tackle 100. I think that would bring out a conversation among Treasury departments that the dollar has gone far enough. We've already seen the big lows for the euro. We see it in cable. I think some sort of coordinated intervention would be necessary to stem this rush. And you know, the dollar at these levels doesn't actually help the Fed situation at all either. Mm-hmm. So it would be beneficial all around.
And it doesn't help any other central bank either. I mean, the massive moves that we saw from the BOE and the gilt market, like not at all reflected in the currency market. Eddie, it's hard to really tell how much is the dollar story and then how much of it is like dysfunction
in other markets. Eddie, just walk me through these kind of moves that you're looking at and your team's looking at.
Absolutely. I think, it just adds to that sense of crisis in markets, right? We sort of felt like it started to look as if things were calming down, but when you see the long end of the yield curve just move that much and it feels crisis time, then, central banks do have to step in. And I agree with Vince, and I think, this is one of the fun things about having Vince on the team with us, because he's not only been there and seen it, he was there and trading it. But I think, what we're seeing this time around is whether we get a coordinated effort or whether we're seeing the central banks one by one going it alone, I think action is going to be required for a lot of the central banks. And I think, I think a lot of them will just have to be a lot more aggressive on raising rates. I think whether the question is how they address it, not whether they're addressing it. Yeah. I think they are going to have to address it. But the question is whether they're going to address it purely through monetary policy or whether they're going to have to step into the market.
That? Today wasn't about monetary policy from the Bank of England. Today was about financial stability. Are we pivoting from a focus on monetary policy to central banks worrying about financial stability? Ultimately, that's what they need to preserve at this point. If you want to have a functioning market, you have to preserve financial stability. The Bank of England had a major crisis in the pension industry. It needed to deal with it. Are we going to see other central banks having to pivot to that, away from the rate hiking that you're talking about?
I think you nailed it on the head there. I think, when you see your pension industry starting to struggle, when you see these kind of moves on the long end of the yield curve, that really spooks central bankers because it signals instability in financially important institutions that's going to affect everybody, all of their consumers. So I think this is something that worries people. But I think, I think the fact that central banks in Europe and UK and elsewhere have not been aggressive enough in raising rates in the first instance is why they are struggling with these problems. We've seen with the yen, for instance, they were behind the curve on hiking rates. We saw with the Bank of England, they hiked less than the Fed at the last meeting. And those are the places that now have to take additional steps. So I do think it's the failure of monetary policy that is forcing their hand into being more aggressive on other fronts.
So Vince, I hear what you're saying, that if we get to say parity on the cable rate, that's going to prompt the calls between the Treasury heads, etc. But Janet Yellen just yesterday said, look, the market is functioning properly. That doesn't sound like someone who's worried about dysfunctioning markets. And the UK in that respect seems quite idiosyncratic.
Well, I would point out the fact that Ms. Yellen also thought it was transitory inflation. I think we potentially could see a similar problem here in the U.S. with the pension situation, with equities down this low, and we're probably going to see some ugly earnings coming out given where the dollar is in the FX space, which reduces earnings per share in large corporations. We saw it particularly with Microsoft in the last round of earnings calls. The central banks, I'm not so sure realistically who's been more irresponsible. The too much money put in during the pandemic from Treasury departments, or the laissez-faire attitude of central banks, and now being too aggressive in trying to raise rates to secure their credibility. I mean, it's really just a credibility issue. They blew it with the transient policy. Now they're trying to get their credibility back by raising rates aggressively. I think egos aside, we need to have central bankers and treasurers sit down and look at the markets and look at what's going on and deal with this in a rational way. We've put too much money into the system. We've kept rates too low for too long, and now we're aggressively going the other way. What Truss's policy of cutting taxes, thinking that's going to help a recovery when you're in an inflationary environment, or this Inflation Reduction Act, I don't know where the economic textbooks are that these people have hidden, where they think if they spend money, that's going to lower inflation. There needs to be a much more sound approach to this, or we are going to see financial markets react in an unsavory way by attacking these systems.
Yep, and that's exactly the point that Mohamed El-Erian was making earlier to John Farrow, that idea that exiting this kind of monetary policy over the last 12 years, 10 years, things break, and we're already seeing that even if certain areas of the UK are specific to that fiscal plan. Guys, thanks a lot. Wish we had more time. Vince Signorella of Bloomberg and Eddie Vandervalt in the studio with a tie next to me. Very exciting. All right, coming up, continuing the conversation, the dollar soaring to another record, the IMF telling the new British government to rethink those tax cuts. We're going to talk to the Deputy CEO of Man Group next. How do you trade all of this? Mark Jones will be joining us. This is Bloomberg.
when business news
The
breaks.
pound falls to an all-time low.
Kwasi Kwarteng is going to add to his fiscal package on Friday with even more tax cuts.
Trust Bloomberg for the fastest coverage and instant expert analysis.
This is just putting further pressure on inflation and interest rates.
It would not surprise me if the pound eventually gets below $1.
How does the Bank of England respond to this without looking like it's panicking?
There has to be shock and awe to some extent.
For continuing coverage, keep it tuned to Bloomberg Television and Radio.
Well, this shouldn't really count as any sort of crisis per se. If you look at sterling on a trade-weighted basis, on a real effective basis, it's not all that weak. So, don't respond in a sense. The dollar is really the dominant story behind a lot of what's going on here.
That was Alan Ruskin of Deutsche Bank addressing the dollar's impact on the turmoil in UK markets. What do you do if you're trying to make money in this environment? Mark Jones, the deputy CEO of Man Group, has about $142 billion in assets under management, is the largest publicly traded hedge fund on the London Stock Exchange. And he joins me now in studio. Hey, Mark, good to see you. Thank you for joining us.
Great to be here. Nice to be on the calmer side of the Atlantic.
Yeah, for now, maybe. So our question of the day was, do we get a Plaza Accord 2.0? And I guess that's just our way of asking, how much of the damage that we're seeing in the market is actually dollar-related versus idiosyncratic to the UK? And how do you think about this?
Sure. So I think it's pretty early to be talking about Plaza 2, and in particular because the Fed's doing what it's doing for domestic US reasons. Its mandate is not to deal with the pain that we're seeing in the rest of the world. And until it gets inflation down, I think it's too early to be talking about that sort of event. On the UK side, there's obviously a lot that's UK specific. The reaction to the mini budget was pretty dramatic in markets. But most of this story is about dollar strength and about what the Fed's been doing.
Mark, good morning. It's Guy. On the other side of the Atlantic, not so calm. Are things starting to break, though, because of dollar strength?
Yeah, the Bank of England put it, I think, well. Markets have been disorderly in the UK over the last 5 days. That's why you've seen them step in. That's part of their mandate. Hopefully they calm things down, but I think the market's still going to need to see more of a monetary response, more of a fiscal response, but at least this buys some time. If you talk to the trading desk, they've definitely said there's been some violent unwinds going on. There's obviously the stories around pension funds needing to unwind hedges, and you can definitely see some of that in the market. But central banks are powerful. I would expect that they can get markets back into an orderly fashion.
How? When? What do they do to do that?
Well, you've obviously seen them move back to QE, which is a very powerful weapon in G7 economies where you're printing your own currency. It's obviously not the direction they want to go in longer term to get inflation under control, but in the short run, they can always pull that lever and get markets back in order.
It seems slightly odd, though, that we're in a situation where the market is saying you need to raise rates aggressively, but the bank is responding with QE. Are those two things compatible?
There's definitely a tension there, to put it mildly. I think it's about time frames. The moves that we were seeing over the past few days, they are simply too dramatic for a central bank to tolerate. They have to step in, which is why you've seen them take that action. There's then the longer term where, yes, we know that we need to see rates come up. We have to get inflation under control. It's causing a lot of pain in the real economy. They will want to pivot back to that mandate. You saw them in the announcement this morning saying that they want to get back to shrinking the balance sheet. Whether they can really do that on the time frame that they were talking about, I think we're going to have to watch markets and wait and see. But that's what they're trying to do. They're trying to manage a short-term pressure and then move back to a long-term objective.
So it feels like the conversations that keep percolating in the market is how much cash should you be in when you put it to work? When do you buy long bonds? If you bought that yesterday in the UK, you're probably feeling pretty good, but still, that's a whippy trade to have to manage. Yep. And what kind of volatility regime are we going to get into? Hedge funds are supposed to manage all of this perfectly, so what are you doing?
Yeah, so look, macro hedge funds have been a great strategy for doing exactly that through the course of this year. They've been seeing the big trends and they've been riding them. So obviously long dollar's been great, short bonds has been great. Earlier in the year, some of the commodity positions. And I think they've been well placed to keep those trades on. So discretionary investors have kept trying to pull back. They've kept trying to fade the Fed. And the Fed, I think you need to believe what they say at the moment. So that trend has been strong and I would keep running it.
If the Fed is to be believed, what does that mean for equities?
Yeah, I mean, the equities are in there's two challenges, clearly. One is, are we going to get a recession, and in which case, what do we think earnings look like? You really haven't seen that in estimates yet. And that's going to start percolating through as you start to see the pressure into the real economy. And then the second bit, which I think is possibly equally important, is just the capital flow piece. There's going to have to be flows into bonds in due course. You know, we know that QE's coming back in the US. There's a lot of bonds to buy, and yields are starting to get attractive to people. So there's actual return to be had in fixed income, not just risk. So you're going to have a capital flow move at some point. To your point, I don't think we've seen it yet. People are still nervous around buying it, but you can see people looking at the market, and at some point those flows are going to start to impact equities.
Okay, what happens to credit?
So I've heard people call default cycles for about 10 years, and it hasn't bitten. If you look at credit spreads, they're not really implying any problem in the near term. And we've obviously had people term out debt, so there's not any near-term pressure. You're going to start to see it as inflation eats into some of the weaker businesses, as profit margins come under pressure, and as we start to see some of those refi walls come. But I can't see it in the near term. I think that's a little further out before one has to worry about credit.
Mark, if we're thinking about buying govies at this point, as you say, we're not there yet, but the flow may at some point pick up. What does that tell us about the economy's ability to absorb higher rates? If I believe that we're starting to see value here, is the kind of the next logical kind of part of that thought process that rates can't go any higher, so this is a good time to buy? Or is it simply that this is just that we haven't seen rates like this for a long time, therefore I am attracted to them? I'm trying to understand the logic behind why you would want to buy govies at this level as opposed to a higher level. Why do you not believe that they could go higher?
Sorry.
That's okay. I mean, look, obviously you'd want to buy them at a higher level if you can, if you know the short-term path, and I wouldn't be trying to step in now, but people are clearly looking at it, because if you're a big asset owner, you can't time markets perfectly. You have to start moving flows. Sometimes you'll be too early, sometimes you'll be too late, and I think that's starting to happen because you can actually get some return out. You may not have the perfect moment, but you can get some return. And the impact on the real economy, I mean, at some level, that's the big question for markets. We haven't seen rates at these levels. We haven't yet seen the impact of mortgage rates stepping up. We haven't seen corporate credit rates stepping up, and what that does to both the consumer and the corporate side. That's what the Fed's looking at. That's what everyone's looking at. It's honestly very early to know.
Yeah, it's going to be interesting to work our way through the process of finding out. Mark, it's always a pleasure. Thank you very much indeed. We look forward to you joining us on either side of the Atlantic. To be honest, I think they're both as crazy as each other. Mark Jones, Man Group Deputy CEO. Thank you very much indeed, sir. This is Bloomberg. So when I woke up this morning, this was the story that I thought would be dominating the news agenda today. Apple backing off its plans to boost production of the iPhone 14. This is a huge deal. The company had expected a surge in demand, but it hasn't happened. Why hasn't it happened? Well, let's try and answer that question. We welcome Bloomberg's Ed Ludlow. Ed, why?
Yeah, I mean, generally there's a softening in the global smartphone market, right? Particular emphasis on China. Early data, there was a report from Jefferies, for example, Monday, shows that actually pre-orders for the iPhone 14 in that market are not as strong as they were when you equivalate that data to the early pre-order data in China for last year, right? The last generation of the iPhone. But really nothing's really changed, right? Sources tell us that this plan, which was only hatched a little earlier this year to boost output or units by 6 million to 96 million, is being reversed. So we're back to 90 million, and the sell side reaction is kind of sanguine for that reason. We thought we'd do 90 million units of the iPhone this year, and by all accounts we're still doing 90 million units of the iPhone this year. But the stock reaction is severe, and of course it's weighing on equity markets more broadly.
So the stock is down by about 3-4%.
Right.
What should it be priced at, knowing that they have this slowdown?
Yeah, I think going back to this idea, particularly in China and in Europe, right, where the consumer's feeling pain of inflation and the recession risk is kind of gathering pace, the iPhone sales would be impacted as a result. We're looking at flat unit sale growth. 90 million last year, iPhone 13. 90 million this year, iPhone 14. Is there any difference in this new iPhone? Maybe some are holding off, but the top line growth is only 2% for revenue, right? Why? Because they don't have that much with pricing. They chose not to raise prices when many thought they would. So that's the story. It's flat growth for a company that is accustomed to not flat growth.
Well, okay, let's come on to that issue of pricing. Some people thought they would raise the prices. They didn't in the end. Should they have cut them? Because as you say, maybe the evolution of this product isn't good enough in a market that is already slowing to generate even stable pricing.
So there's an important point in that Bloomberg report. Sources telling us that in China in particular, there's evidence of the consumer going to that higher priced Pro model. Remember, there were 2 standard models, 2 Pro models. So even if the unit or volume growth isn't there, there's hope of a higher average selling price, which higher ASPs mean better top line growth. We even saw some, according to our sources, suppliers pivot their production to emphasize or focus on that higher end. But is it enough? That's the question.
All right, Ed, appreciate it. Thanks very much. It's a fascinating story, and obviously the NASDAQ 100 now up by 0.2%, but barely there. Ed Ludlow coming up. All right, coming up, we're going to talk about housing with the chief economist over at Zillow. We'll break all that down for you. This is Bloomberg. All right, about an hour into the U.S. trading session, the action really over in the UK in the gilt market, but we are looking at tech now on the highs of the session up by 0.6%. Abigail's tracking those moves for us. Abigail?
Well, we do have gains at this time, Alex, and so interesting because each day this week we've had gains at this time, but will they hold? Well, we don't know right now, but it does feel pretty solid, and these gains for both the S&P 500 and the NASDAQ on above average volume. But Alex was just talking about gilts. Let's first take a look at the 10-year yield, and here in the U.S., really pretty amazing, down 14 bips. The gilt, the 30-year gilt, though, at this time, down 100 bips, 1% on the day, and that, of course, on an extraordinary action from the BOE where they are buying gilts, and apparently that operation starting right now. Now, as for that 10-year yield, take a look at here. This is just an amazing move for bonds. We just keep seeing this crazy volatility, buying, selling, as traders are just really off guard around the Fed. It's going to be interesting to see what the longer-term trend is. Of course, on the longer-term basis, the bond market, the bull bond market, 40-year bond bull market does seem to be coming to an end, but anything is possible, so just keep an eye on these moves. As for big moves, you all were just talking about Apple. Here it is, down 3.2%, and some of the suppliers, of course, on that news that demand's not quite as strong as they expected for the iPhone 14. They had popped up the orders by 6 million not so long ago to suppliers. Now they're bringing it back in, so we're kind of where we were, but on the day there's certainly weakness, and when that news had come out earlier, there had been strength, not surprisingly, so a little bit of an inverse move here, but this is one stock that's really weighing on the indexes, even though they're green. If this stock can come off of its lows, imagine what will happen for the indexes. And then finally, relative to volatility, what's so extraordinary about this chart, what we're looking at in blue is the MOVE index, that's bond volatility or the bond VIX. In yellow, we're looking at the foreign currency, foreign exchange VIX, and then in white, we're looking at the stock VIX or the actual VIX. Take a look at the MOVE index. It is not even at its all-time highs, despite basically the 10-year yield and some of these other yields moving 10 plus bips each day on an intraday basis. What will it take to get it back above? Maybe we'll find out, but you can see that there's a tremendous amount of volatility in foreign exchange, and that VIX guy, it looks like it's not all that high, but it is actually relatively elevated above 30. Many thinking that it could, on some sort of a bottoming or capitulation process, go back above 40. Will that happen? I guess we'll have to find out, Guy.
Absolutely. We're not there yet, certainly, but as you say, we are certainly moving in that direction. Abigail, thank you very much indeed. Let's get back to the housing market and talk about what is happening there. Two key figures out today on the U.S. housing market. Mortgage rates have hit a 14-year high, pending home sales fell in August. Now, that's the 7th time we've seen that this year. Joining us now is the chief economist at Zillow, Skylar Olson. Skylar, interest rates are going up. Walk me through the effect that they are having, the effect that they are going to have.
Yeah, well, higher mortgage rates is a pretty big impact on mortgage payments. You know, we had strong home value growth over, a lot of the pandemic, so 2 years worth that put home prices high, but it wasn't until mortgage rates went from 3% ballpark to 5% ballpark that home owner burdens were kind of pushed up into that 30% range where you're spending more than 30% out of your income on your mortgage payment, property taxes, and insurance. Now that interest rates have surged again higher, you're looking at 36% out of your income on a typical home using the typical median household income. That's a big deal. That's beyond where we were during the last housing bubble. And so it's absolutely slowing down housing markets. So we are seeing that sales activity drop. We're also seeing new listings fall back as well.
Okay, so Skylar, what we did see though yesterday was that new home sales in August actually jumped pretty hard, and that's because we did see the 30-year kind of go below 5%. So I'm wondering how active these home buyers are going to be in the market if we see some volatility in that 30-year.
Oh my gosh, yeah. I've been telling people a lot these days, like what has to happen for us to return to normal markets? Price corrections, will help with affordability and bring some buyers back, certainly in unaffordable markets. But that volatility is pretty extreme, and it makes it really, really, really hard to plan. And that's why we're also seeing a lot of different moving in housing markets. So if buyers are expecting 20 basis points swings, that's an incentive to maybe try and wait and catch a window. But this is a very hard market to time, especially when new listings are low. And so this is, the market honestly is behaving kind of weird in some pockets. There are neighborhoods that are still competitive. There are other neighborhoods that are slowing down really fast. And that has a lot to do with kind of the transition moment we're in, and very much so the volatility of mortgage rates right now.
Scarlett, we talk about volumes, which are obviously a useful indicator. Let's talk a little bit about prices. Are we going to see prices coming down? If we see, as you say, affordability changing in the way that it has, ultimately, does that discount into the market, and does that mean lower prices?
Yeah, so right now we're already starting to see prices fall nationally in our raw metrics. So prices are down around $1,500 from where they were in June. That's just a slight decline now, but our forecast does have it further declines into the winter. However, we don't build too much to keep up with the strong, still kind of underlying demographics. And with new listings pulling back, our forecasts do have prices returning, within the next year, so that maybe now, nationally speaking, might be a bit more like buying at the beginning of a plateau than, say, at the top of the market. But that said, things are changing very quickly. And now if, the higher interest rates go, that also, of course, changes that picture. There are markets, the most affordable markets, think Western markets. So think things like Seattle, Boise, Phoenix, where home prices are falling much more significantly, where you've really pushed beyond the ability for a lot of buyers to qualify, let alone afford with higher rate environment.
So, Skylar, I know Zillow is a U.S. company, but the rate increase over in the UK, for example, and many of those guys are on mortgages that are like 2 to 3 year and then they adjust, right? Here we have that 30-year fix. How does that change the economic impact of a housing, I don't want to say crash, of a housing tightening bubble, if that's the right.
Sure. And actually, so that's it. So the 30-year fix is actually one of the things that's going to help insulate prices from falling too much. Think about it this way. We've got a lot of existing homeowners out there. These are our would-be sellers, right? They are currently likely, the huge majority of them are holding interest rates around 3% or lower at a higher interest rate environment. For them, they have a lot of incentives to hold for a while, maybe perhaps even put their unit on the market in order to rent. That pullback in inventory, that pullback in new listings, we're also seeing a pullback in construction as well, of course. That's keeping prices from falling as much as they otherwise would in this kind of environment. I know we've got a lot of people hoping for price corrections to help, re-enter the market, and I don't know that we can promise that except for in these really unaffordable areas because of this dynamic interest rate lock-in.
Skylar, one of the things that is clear in the United States right now is that the employment market is very strong. We're very close to near full employment. But the Fed is making it clear that it's going to have to cause some pain on the employment front.
Right.
When you plug in your numbers and you think about what could happen in terms of unemployment going higher, what impact could that have if we see unemployment just ticking incrementally higher and higher and higher as the Fed tightens?
Yeah, I think this is the tight spot that we're in. I think, obviously when you're buying a big financial decision like buying a home, having uncertainty because of, say, recession risk is, also a worry for people. However, the more signals that we get that push this recession further and further out because the job market is so strong, the tougher the Fed has to be in order to get inflation dynamics to come down, right? So in many ways, good news on not as bad of a recession front often can mean, higher mortgage rates to cool off housing markets. So, honestly, it's kind of a weird spot to be in when we think about, what comes next. And we really are very much so driven by our progress on inflation and by the Fed's plans in order to tackle it. And honestly, the market is clearly not doing a great job fully internalizing what's happening, and that's what's driving a lot of the volatility.
Skylar, such a great analysis. We super appreciate it. We'll definitely get you back. Skylar Olson, Zillow Chief Economist, thank you very much. All right, coming up, Europe's energy crisis. Ukraine Ukraine's Naftogaz says Russia's Gazprom paid for October's gas transit. We're going to get those details and when and if we expect a full shutoff of gas from Russia. Yuri Vitrenko, Naftogaz CEO, coming up next. Plus, President Biden speaking at a White House conference on hunger. He did address Hurricane Ian earlier.
Obesity counseling so they can get the guidance they need to stay healthy. It has not only do people need to know what they should be eating, Our national strategy also calls for doctors, nurses, dentists to be
There's breaking news at the top of the hour. The European Union now proposing a new package of sanctions on Russia. It will include a price cap for Russian oil sold to third countries. Bloomberg's Maria Tadeo joins us now from Brussels. Maria, walk us through what we've heard today.
Yeah, and Alex, it gets complicated because the European Commission talks about this oil cap, but it says it is now setting up the foundations, the legal foundations for this oil cap. So it does seem that this is really something that's in the works, and at this point there's not a lot of clarity in terms of or the ways that it should work. What we also know is the European Commission says it will work now on a new package of sanctions that will also now target trade and people. They say this is in response to Vladimir Putin's now deciding to escalate the war in Ukraine. They said, of course, the mobilization that was announced last week, the fact that he has made nuclear threats over the past week, and of course the fact that the referendums, which they call a fake, a phony, a scandal in those occupied territories in the east of Ukraine did go forward. At this point, the European Union says the response is to increase the pressure on the Kremlin.
Well, part of this obviously in response to what is happening in Ukraine. The expected response from Russia is one that we're going to be watching out for very carefully. Clearly over the last few days, Maria, we've been watching what part of that response has been. We've seen, and there's talk of sabotage in Europe, the huge bubbles of gas coming to the surface in the Baltic Sea, Nord Stream 1, Nord Stream 2 with holes in them. There is expected obviously to be further action. What form does that take? Well, let's try and find out. Yuri Vitenko is Naftogaz's CEO. Let's talk about what is happening here. Naftogaz is the transit operator of Russian gas through Ukraine into Europe. It also obviously manages the network in Ukraine. Yuri, we've spoken to you before about the fact that the Russians have left your transit facilities alone. Are you now worried, having seen what has just happened with Nord Stream 1 and Nord Stream 2, that that is going to change?
Yes, risks are increasing drastically, especially after an explicit threat from Gazprom that because we went to arbitration, because they were not paying and fulfilling the contract, they're now threatening us with Russian state sanctions. And then what can follow is some attack on our infrastructure. We still hope it won't happen because the whole world understands what Russia is doing. So I don't think that they will be able to get away with all this sabotage, but the risks are increasing.
And Yuri, of course, you mentioned the word that sabotage, and here you've worked in this industry for many years. When you see the pictures yesterday from that explosion, the leaks, does that look to you like an accident, or is that something that was carefully planned?
I know from my experience of dealing with Gazprom is that basically it's Putin who decides. I needed to negotiate a new transit contract with Putin before I could negotiate it with Gazprom. So I know that it's not just an ordinary pipeline. It's a tool for Putin, at least to abuse the market dominance of Russia in Europe, but also it's a geopolitical tool to influence decision-making inside Europe. So that's why, for me, it's just a clear sign that Putin is using this tool